Hello, welcome to Thursday. This week is all about the Fed, as you might imagine, and we'll spend a little bit of time on question of the week, which is just a quick update on the Washington State capital gains tax, just some new news out on that front. So we'll make sure to kind of debrief a little bit as to what's going on. Had a great time in Arizona actually yesterday, last weekend, and glad to see the sun has maybe followed me a little bit because I think it was supposed to be raining, but hopefully everybody's gearing up for a nice spring here as we move into March. And maybe paying attention a little bit to this Fed craziness that happened on Wednesday, which again is really where we're going to spend nearly all of our time here this week. We've got a lot to unpack, so let's kind of get right into it. And before we touch on the Fed, one thing I'll mention just real quick prior to that is that inflation data came out between now and our last update last Thursday as well. And that inflation data, as you might expect, was much higher than expected again. So here we go again, still extremely high inflation numbers. Really probably no surprise, but yet we keep coming in with estimates lower. So inflation is still here. It's gotten worse, and certainly shows signs that this will be continuing to show some ongoing price increases for some time to come. Obviously, a lot of it, to be very clear, is coming from a lot of the Russia-Ukraine tensions, because a lot of it has been driven by oil prices, but it's not the only piece of this. So a lot of other areas have increased as well. And again, it's if you really look at what's going on, I think it's showing very clearly that inflation will probably be here for some time to come. Which is a great segue into the Fed. So the Fed announced on Wednesday that it is officially increasing the Fed funds rate by 0.25%, or 25 basis points is what you'll hear me refer to it as for the rest of the chat here today, which again is just 0.25%. Basis point is a factor of a percentage. So it's exactly what we expected, right? Powell had suggested this in his testimony a few weeks back. We talked about it a couple of weeks ago. We also kind of hinted that, last week, hinted that this was probably going to be the case. And what was interesting is that I think there's 9, but one Fed chairman believed that the increase should have been 50 basis points. Obviously, the others did not, and so we ended up with the 25 basis point increase. The dot plot also showed, which kind of is supposed to show like a projection, essentially, of what the different Fed members think or feel that we should increase rates over the course of the year. And it was suggesting 6 rate increases through 2022, basically 25 basis points each. And as you look out to like 2024, I saw the news cover this a lot, which I thought was funny, but it said 2.8% by the end of 2024. Who the heck knows? Like if you're hearing a lot about the interest rate in 2024, there is no clarity around that whatsoever. So I think you can kind of throw that out the window, focus more about what's going on right now, and obviously the current increase, but also potentially what may be to come through 2022 here. The 10-year Treasury just spiked. I mean, we're up near 2.2%. Huge jump on this recently. The 2 years up near 1.95% after this. So we have seen interest rates increase significantly. In fact, depending on how you've structured your bond portfolio, you may have noticed that your bonds are down quite a bit. The general bond market year to date is down, I think, 6.5%, 7%, something like that. So, we've been talking a lot about making sure that you're managing risk in your bond portfolio. And this is exactly why it's been a tough go so far here in 2022 for that safe part of your portfolio. So it's been very important to make sure that you're managing risk in your bonds and not just kind of looking at them as a traditional hedge, as it has been historically. Let's see what else came out. So this week, they also mentioned that they will potentially begin reducing asset holdings at a coming meeting. Very interesting. We've talked about, the Fed saying that they will slow down asset purchases. This, I believe, was the first time we've really heard them hint anyways. They didn't commit to it, but hint at potentially reducing asset holdings in the meetings to come. And I think that what we saw in the markets really reflected that part of it. It was no surprise whatsoever that we were looking at 25 basis point hike. I don't think it was any surprise whatsoever. The Fed said that they're going to raise rates each meeting. They mentioned that in the testimony last week. Whether they do or not, by the way, stay tuned. My perspective on it is that they may not, just because there's so much uncertainty. And if some of this continues, they may slow that down as the year kind of carries on too. So definitely want to watch that closely. But all that was pre-planned. All that was very much, what's the word I'm looking for? Forecasted. The Fed, hinted at that time and time again. And so I don't think it was much of a surprise. But obviously, the reducing the holdings portion of things was a bit of a surprise. And we saw the market go from up 2% to basically flat, and then picked back up again to close up near, I think, 1.5% or so, all on one day. So it was quite the day in the markets. And obviously, we'll see what comes as things kind of continue to unravel from here. The yield curve, I think, was something really important to watch. It narrowed significantly. So what that means is short-term rates are very similar to long-term rates, right? In other words, a 2-year bond is paying the same interest rate, near the same interest rate, as a 30-year bond. And I think if you think about it this way, really what the market is saying is that they only really need a small amount of higher interest to hold a bond for 30 years versus only 2 years, right? They're saying it's well worth the tiny bit of interest that they get to hold something for 30 years and not 2. And this is, it's something to really pay attention to. You've probably heard a lot in the news about an inverted yield curve, which means that they actually pay you more to hold short-term interest rates, 2 years, for instance, versus long-term at 30 years. It's very possible we see this. Now, what I want to share is that generally speaking, an inverted yield curve can be a sign of recession. My perspective on that personally is that I don't know that this time is necessarily, if it happens, by the way, is necessarily the same situation. And the reason I say that is because the Fed has been keeping interest rates down artificially, right? So this is not a natural market movement where the short-term rate may go above the long-term. It's due to, I don't want to say manipulation, but it's due to the Fed controlling the markets to some degree, right? So again, it doesn't mean it doesn't mean that it's not possible we see some negative impacts of it, but I do think that this is very different, and because of that, just that in and of itself, I don't think is the same as it has typically been when we see an inverted yield curve. So again, it was quite the ride here this week. There's obviously going to be a lot to come here in the weeks to come, so we'll make sure to touch on that. But the interest rates, the stock market, and this inverted yield curve is something very important to watch to come. As for the question of the week, so update on the Washington State capital gains tax. For those who remember, this went into effect beginning January 1 of 2022. And it essentially says for Washington State residents, if you were to sell an asset with a gain of $250,000 or more, home excluded, some family businesses excluded, some other things are baked into that as well. So let's just assume you sold a stock at a $250,000 gain. There would be an extra 7% tax on everything above that. So they have been, this bill has been in the courts for a while here now, and just recently a judge overturned the ruling stating that this was unconstitutional based on Washington State's constitution, basically saying that this is an income tax, right? So that's been the argument since day one. A lot of people felt this wasn't going to actually be carried through. Here we are mid-March or so, and a judge has officially overturned it. Now, it's still going to the Supreme Courts, as it always probably was going to. So I don't think there's any surprise there. But this is kind of the first thing to grasp onto, that this may get overturned. And we'll have to see what comes of the Supreme Courts, of course. But it's looking more likely that may be the case. So we'll continue to keep you posted on that. But wanted to provide a quick update given the changes here. And just a quick one because we had so much to cover with the Fed. So hopefully that's helpful. Definitely pay attention to interest rates, pay attention to the yield curve and stocks to come. We will see you next Thursday, where we'll kind of break down any progress or updates since. As always, join us every Thursday at 3 p.m. for the market news here. And let me know if you have any questions. I'd be more than happy to cover them in our weekly question of the week. Have a great day. We'll see you next Thursday at 3.